In the last 48 hours of one of the most chaotic stretches the metals market has seen in years, silver went from a reported peak near $121.60 to roughly $85 an ounce. Not months, not weeks, in 2 days. And that kind of move breaks the assumptions most traders carry around like gravity. Silver is not supposed to behave like a meme stock. Silver is supposed to be the slow, stubborn metal that creeps, not sprints. But then the infrastructure underneath silver blinked. On January 31st and in 2026, the exchange that sits at the center of Western price discovery tightened the rules of the game. That sounds like paperwork until you understand what a margin hike really is. It is the market S equivalent of suddenly demanding a bigger deposit at the exact moment everyone is already scrambling for cash. It forces leveraged players to post more collateral immediately or get pushed out. Here's the part no one is discussing. While the public watched the price fall and called it the market calming down, the institutions were watching something else. They were watching the plumbing, collateral requirements, mechanical selling flows, and the one signal that has been screaming from the other side of the world, the Shanghai Premium. Welcome to Signal Illinois, where we decode what matters before it becomes a headline. If you've been around this channel, you know we don't do theatrics. We do mechanics. We look at what the data is forcing, not what the crowd is feeling. If that's the kind of analysis you value, consider staying close, the way you'd keep a wise elder in earshot. And tell me in the comments where you're watching from. Because the geography matters more in silver than most people realize. The story is that multiple powerful forces hit the market at the same time, and the collision revealed a contradiction that can't last. Start with the price action. A move from a triple-digit high to the mid-80s is not a normal correction. It is a liquidity event. It is the market announcing that, for a moment, sellers were not just motivated, they were compelled. That kind of compulsion almost never comes from a change in fundamentals in 48 hours. It comes from positioning and leverage and rules. When margins rise, the most leveraged players become the first sellers, not because their view changed, but because their balance sheet did. Imagine you holding a seat in a theater, and the venue suddenly says, your ticket is no longer enough. You must pay a second deposit to stay seated. Some people can, many cannot. They stand up and leave, and the crowd behind them starts moving too. In markets, that movement becomes cascading sell orders. But margin hikes don't happen in a vacuum. They tend to arrive when volatility is already elevated. The exchange is responding to risk, but the response itself changes behavior. And that SY margin hikes have a reputation for acting like gasoline on a fire in the short term. They squeeze the same side of the boat at the same time. Now, layer in the second force, index rebalancing. There is a mechanical flow that few retail participants track because it feels abstract, but it moves real contracts. In early January, the Bloomberg Commodity Index rebalance window, January 8th through January 14, was expected to trigger large futures adjustments, $8 billion of silver futures selling tied to that rebalance. Think about what that means. It's not an opinion about silver. It's not a forecast. It's a rules-based flow. Mechanical selling is different from discretionary selling. Discretionary selling can stop when the price gets cheap. Mechanical selling keeps going until the mandate is satisfied. That creates a very specific type of pressure. Persistent, time-bound, and indifferent to valuation. So you have a market already volatile, then a wave of rule-driven selling, and then a sudden increase in collateral demands. That combination can produce what looks like panic even if nobody is panicking. It's just a system trying to rebalance itself. But then we arrive at the central mystery. While Western paper markets were getting hit with forced flow and higher margins, the physical market in China was sending the opposite message. The Shanghai Silver Premium, the gap between prices in Shanghai and Western benchmarks, was elevated to levels that traders watched like a siren. Reports in late December described premiums of over $8 an ounce at points, and that is not a minor difference. That is a statement about local scarcity, local demand, or both. This is the dislocation. Paper says relief. Physical says strain. West says sell. East says pay up. Two markets telling opposite stories is not a stable condition. It can last for a while, but it cannot last forever, because the entire purpose of a global market is that arbitrage eventually connects the dots. When the price gap gets large enough, metal moves, capital moves, or the paper price snaps to acknowledge reality. Something has to give. To understand why, we need historical context. Because silver has run this script before, and the pattern is remarkably consistent. In 1980, silver surged into a frenzy, driven by concentrated buying and a broader inflationary backdrop. The story ended with aggressive margin increases and rule changes that accelerated forced liquidation. The price didn't simply drift down. It broke violently as leverage was squeezed out. Regardless of how you interpret the motivations, the mechanism was clear. Tighten collateral during a spike, and you can trigger a cascade. In 2011, silver rallied hard again, climbing into the high 40s before a sharp reversal. Once more, margin requirements were raised in a short span, and the market experienced a sudden, dramatic drop. Traders who were fine at yesterday's collateral level were not fine at today's. That forced selling fed on itself. The most important takeaway isn't the exact numbers from that era, it's the behavior. When volatility rises, the system raises the cost of carrying risk. The price often overshoots both up and down. Now look at what's happening in 2026. We see the same ingredients, a sharp upward move, then extreme volatility, then a margin hike that changes the carrying cost overnight, with a mechanical flow backdrop that amplifies the move. The playbook doesn't have to be identical to rhyme. It just has to repeat the core physics. And physics is exactly what this is. Markets are not just stories, they are constraints. They are collateral, settlement, and the ability to fund positions. That brings us to the players, because this isn't one market, it's a network. On one side, you have the futures complex, where price discovery is heavily influenced by leveraged positioning and short-term flows. The COMEX contract structure and the clearing system determine how much cash is required to hold exposure. When that cash requirement rises, the market forces a decision. On another side, you have the London over-the-counter market, which is the center of the wholesale precious metals ecosystem. London Vault data reported holdings around 27,818 tons of silver at the end of December 2025, roughly 927,254 standard bars. Some metal is allocated, some is pledged, some is part of long-term holdings. The headline number doesn't tell you how much can move quickly when demand spikes. Then you have Shanghai, where the physical market has its own dynamics, its own inventory habits, and its own demand drivers, including industrial needs and investment behavior that can shift rapidly with currency expectations and policy signals. And sitting above all of this are the institutions that move size without announcing it. Banks, commodity trading firms, large funds that follow indices, industrial users hedging input costs, and critically, the exchanges and clearinghouses that change the collateral rules. When a margin hike happens, it doesn't target a single institution. It targets the entire ecosystem of leverage. But the impact is uneven. Players with deep cash buffers can hold through it. Players operating on tight collateral get flushed. That means the rule change doesn't just reduce risk, it redistributes positions from weak hands to strong balance sheets. This is where it gets interesting. If the physical market is tight, strong hands may welcome the flush because it allows them to accumulate exposure at lower prices while the paper market is temporarily distorted. The public sees falling prices and assumes demand disappeared. Institutions see forced liquidation and ask whether they are being offered inventory at a discount to physical reality. It's the meaning behind that premium. A premium in Shanghai relative to Western benchmarks can happen for several reasons. It can reflect import constraints, refinery bottlenecks, financing costs, local tax considerations, or a sudden surge in demand that outpaces immediate supply. It can also reflect a situation where available metal in one region is less accessible than the headline global supply suggests. And when that premium persists, it implies that arbitrage is not fully closing the gap. Either it's too hard to move metal fast enough, too expensive to finance, or too risky because the paper price is whipping around and making hedging uncertain. Think of it like water levels in connected tanks. If the pipes are open, the levels equalize. If the pipes are clogged, one tank can be high while the other is low. The premium is a measure of that clog. Now consider what margin hikes do to arbitrage. Many arbitrage strategies depend on holding offsetting positions. Long physical or long one market, short futures, or short another market. If margins rise, the cost of holding the hedge rises. That can force arbitrageurs to reduce activity at the very moment it is most needed to equalize prices. In other words, the thing that is supposed to connect the markets can get temporarily shut down by higher collateral requirements. So the dislocation can widen. Not because fundamentals changed, but because the bridge between markets got more expensive overnight. This is why you can see something that looks impossible. A paper market collapse alongside a physical premium that stays elevated. People assume a single global price. In reality, there are prices, plural, connected by imperfect mechanisms. Now let's talk about the mechanism of how this kind of shock unfolds. In plain language, picture a stack of dominoes, but each domino is a leveraged position. When volatility rises, the exchange raises margins. That removes the smallest dominoes first. Those are the traders and funds that were using maximum leverage. Their forced selling pushes the price down. That price drop triggers risk models and stop losses, and it increases margin calls further, because margin is often a percentage of contract value plus volatility buffers. More margin calls mean more forced selling. That loop is reflexive. At the same time, mechanical selling from index rebalancing is hitting the tape. Those flows don't care about the price level. They care about finishing the mandate. So even if discretionary buyers step in, they're absorbing a wave that keeps coming. Now add one more layer, sentiment. After a violent drop, many participants who might buy become cautious, not because the metal isn't attractive, but because they don't want to catch a falling knife. Liquidity thins, spreads widen. That makes each incremental sell order have more impact. This is how a market can overshoot. Not because the world suddenly has too much silver, but because the market's ability to warehouse risk gets impaired for a period of time. And while all of this is happening, the physical market is living on a different clock. Industrial buyers still need supply. Fabricators still need feedstock. In regions where supply chains are tighter, premiums reflect that reality. They don't move tick by tick with futures. They move with inventory and delivery. So what does the evidence say when you put the pieces together? 1, the collateral rules changed materially and abruptly. A jump from 11% to 15% is not a rounding error. It is a large increase in the cash required to hold the same exposure. That change has immediate consequences. $8 billion in silver futures adjustments. That is the kind of flow that can distort price in a short window. 3, physical indicators in Asia were signaling tightness through elevated premiums. A premium over $8 an ounce is not noise. It is a price signal. 4, the Western Vault ecosystem shows large headline holdings, but those figures do not guarantee immediate availability, especially when metal is allocated or pledged. The difference between there and deliverable is where squeezes live. Now, what does this combination historically suggest? Historically, when paper markets are hit by forced liquidation while physical tightness signals persist, one of two things happens over time. Either physical tightness eases because supply responds and demand cools, allowing paper prices to remain depressed, or the paper market rebounds sharply once the forced selling completes, because the price snaps back toward the level that physical buyers were already willing to pay. Notice the wording. This is not a prediction, this is pattern. And that pattern is why this setup matters. Because the next move in silver from here is less about opinions and more about whether the mechanical pressures fade before the physical signals do. There are a few scenarios to watch. In a conservative scenario, the Shanghai Premium cools as supply routes reopen or demand normalizes, while Western futures stabilize under higher margins. In that case, the dislocation closes not through a price spike, but through a premium fade. The signal would be a steady narrowing of the premium and calmer volatility. In a moderate scenario, the mechanical selling completes and collateral pressure eases, and then the paper price rebounds toward physical reality, creating a sharp recovery that looks surprising to anyone who only watched the crash. The signal would be improving liquidity, shrinking spreads, and a shift from forced selling to discretionary positioning. In a more aggressive scenario, physical tightness persists or intensifies while arbitrage remains constrained, and the paper market is forced to reprice higher in a violent snap because the disconnect becomes too large to ignore. The signal would be sustained premiums, stress in deliverable inventories, and continued volatility in futures, even as physical bids stay firm. So what should be watched specifically? Watch margin policy and any additional changes because collateral is the throttle on leverage. Watch index and fund flow windows because mechanical flows can dominate price temporarily. Watch regional premiums, especially Shanghai, because they reflect physical urgency. Watch deliverable inventory metrics and reports from the wholesale hubs because that's where the rubber meets the road in a physical market. If that sounds like a lot, here's the simplifying lens. Silver is not just a metal, it is a system. And systems break at the connections, not at the center. The connections are arbitrage, financing, and settlement. When those connections are stressed, prices can diverge. When they heal, prices converge, sometimes violently. This brings us to the choice ahead, and it's not a choice about being bullish or bearish. It's a choice about what you pay attention to. Most people watch the price and react. They see a crash and assume the story is over. Or they see a spike and assume the story just began. But the market is often doing the opposite of what the crowd thinks, because the crowd is watching the surface. A smaller group watches the mechanics. They watch margin changes, not because it's exciting, but because it reveals who is being forced to move. They watch index rebalance windows because it tells them when price might be pushed by non-economic reasons. They watch physical premiums because that's where real scarcity shows up first. Information gap becomes behavior gap, and behavior gap becomes outcome gap. Institutions moved first in this episode. They always do because they are closest to the plumbing. By the time retail narratives catch up, the mechanical flows have often finished and the price has already changed direction. That's not a conspiracy. That's just how structure works. So when you hear someone say, silver's dead or silver is unstoppable, remember what the data just showed. In 48 hours, the system tightened collateral, mechanical flows hit the market, and physical premiums told a separate story. That's not a simple market. That's a stressed market. And stressed markets don't resolve with comfort. They resolve with clarity. Let's go one level deeper into why the Shanghai Premium matters so much, because it's easy to dismiss it as local noise if you've never watched how physical tightness starts. When demand tightens in a region, the first thing that happens is not a global headline. It's a dealer telling a buyer delivery will take longer. It's a fabricator paying extra to secure immediate supply. It's a refiner quoting wider spreads because feedstock is harder to source on schedule. Those are small frictions, but they leave a footprint in premium. By the time the premium is multiple dollars per ounce, the friction is no longer small. It becomes a signal that the region is willing to outbid the rest of the world for metal that can be delivered now. Here's the twist. If physical premiums can rise at the same time, paper prices fall because a paper sell-off changes the behavior of intermediaries. If a wholesaler believes tomorrow's futures price could be meaningfully lower, they may be reluctant to inventory metal today unless they can hedge. But hedging requires margin. When margin costs jump, the hedge becomes more expensive. So the wholesaler reduces inventory. That makes immediate physical supply feel tighter, which pushes premiums higher. Now consider the institutional timeline. The index rebalance window is known in advance. Large funds and banks model it. They know the approximate size and direction. That doesn't mean they can front-run it perfectly, but it does mean they can reduce risk before the flow hits. They can lighten leverage, widen quotes, and step back from providing liquidity. Retail participants usually learn about it after the move when someone posts a chart. This is the information asymmetry that matters. Not secret news, but the difference between living inside the calendar of flows and reading the story afterward. There is also a misunderstanding about who moves silver. People imagine a single villain or hero. In reality, it's a crowd of mandates. A commodity index fund sells because the rules tell it to. A bank trims exposure because risk limits tell it to. A market maker quotes less aggressively because volatility makes inventory dangerous. An industrial user buys because production schedules tell it to. None of these actors need to agree. Their incentives just need to collide. That's why the London Vault number should be read carefully. Tens of thousands of tons sounds like an ocean, but oceans can still have bottlenecks. If the metal is sitting in the wrong form, in the wrong location, under the wrong ownership, it doesn't solve a near-term shortage. And if financing conditions tighten, even metal that is theoretically available can become practically unavailable because moving it requires capital and hedging capacity. So when you hear the phrase, the Shanghai Premium is screaming, translate it into mechanics. It is saying that in a key physical hub, the bid for real metal is not aligning with the paper price implied elsewhere. It is saying someone is paying up to secure supply now, not later. And it is saying the bridge between these worlds is strained. If the bridge heals, the premium should fade. If the bridge stays strained, the paper market has to do more work to reflect the physical market. That hinge is why Silver's next move can shock people who are only watching the candle and not the connections. And when that reconciliation comes, it rarely arrives gently. It arrives as a repricing that feels sudden, even though the signals were already visible for weeks.